sound check 1 2. What's going on, people? Let me see if I'm live because I had some technical difficulties earlier on. I was trying to go live, but you know how technology goes, man. You got to keep doing it over and over until you get it. So if I am live, if you're watching this or if you're watching the replay, you can always leave a comment or a question regarding business funding or business how to get funding for your business. That's what I'm going to be talking about. I'm going to be talking about how to structure your business for funding for 2021, right? There's a lot of funding that's going to be available for business in 2021. It's just a question of knowing, what type of funding you can get. Okay, so it looks like I am live. All right, people. So I am live. So greetings to everybody that's watching this right now. Right. Hey, listen, if you're going to start a business in 2021, you got to be persistent. You got to be active. You got to understand technology. If it doesn't work, you got to keep using it and understand it so that way you can get your business up and running. Because, technology, there's so much available. But sometimes when it works, it works. When it doesn't work, it doesn't work. So that's what you got to do. But today's video, we're not going to be talking about technology. We're going to be talking about money, how to get some funding for your business, how to get some capital, how to structure your business for funding. So that's what we're going to be talking about for this video, how to structure your business for funding. Okay. Now, this video is sponsored by BIA Media. You can go visit BIA Media at biamedia.ca. BIA Media is an independently owned media company that promotes small businesses in different communities. So you can go check them out and see what kind of content that they have. And also, it is sponsored by My Credit Funding as well. My Credit Funding is a financial literacy, credit education, and business training educational firm that helps individuals to manage, understand, and leverage their credit. All right, so let's get into the presentation. So we're talking about how to structure your business for funding for 2021. Okay, now if you're watching this now, right, you can always leave a comment, leave a question if you want to know more about funding, about credit, and so on. So if I don't see the question now, I'm going to reply to it later on. But feel free to ask any question that you have about funding, business funding, and credit. Okay, so let's get to the presentation. So what do you need to know for 2021? Right, what you have to do is this: you got to register your business, right? You got to set up your business entity or your business structure. Now, your business could be set up as a sole proprietor, as a partnership, or as a corporation. Now, for the purposes of funding, right, you want to set it up as a corporation. Why? Because corporations are the most fundable entity or the most fundable, business structure that it's out there, right? So you want to set up your business as a corporation because it's the most fundable entity. Why? Because I'm going to give you an example. Just look at the CEBA, the Canada Emergency Business Account the funding or loan that the government of Canada was putting out. When it was originally launched in April of this year, right, a lot of small businesses were having difficulties accessing this funding. Why? Because they didn't have a personal bank account, and a lot of them were either registered as a sole proprietor, and the banks and these other institutions were asking for so much documentation for them because they did not have a proper business structure. And that's what I'm talking about today. I'm talking about how to structure your business for funding, because corporation is the most fundable entity. So when you're structuring your business, you're going to either have it set up. So when I mean by structure, I mean your registration type. Are you going to have a sole proprietorship? Are you going to have a partnership? Or are you going to set up your business as a corporation? Now, for the purpose of funding, right, corporations are more fundable than any other business entity, than a partnership or sole proprietor. Why is that? When your business is registered as a sole proprietor, which means you are the legal entity, so you and your business are one. That's what you call sole proprietorship. It means that when it comes to funding, all funding decision is based upon your personal credit, right? Your personal credit plays a critical role when it comes to you getting funding. So when your business is registered as a sole proprietor, and you're going to get funding under your business name, because you and your business are the same, because you've registered your business as a sole proprietor. What happens is this: if you have bad credit, or if you have no credit history, or if you have poor credit, then you are limited in funding, because banks will make a funding decision based on your personal credit. So if you, the legal entity, right, you, the individual, you and your business are one. If you have bad credit, then you're pretty much done. You're not going to get any credit, right? Because you are attached with your business. You and your business are one. Same thing with partnership, right? So if you have two partners and both partners have bad credit, poor credit history, or they have no credit history, then you're also limited in terms of partnership. Now, when you have a corporation, right? A corporation, one strategy is you can always add directors, right? So you can have up to 4 directors that are eligible to get funding. So each director will have to have a minimum of 25% ownership in the corporation. So which means if one director has bad credit, then the other 3 directors can still go to the respective financial institution to get funding for that corporation, right? So let's say you registered a business, right? But you have bad credit and you can't get funding under your corporation. You can go and add 3 more directors that have good credit. Now these directors now can go to their financial institution and get funding for the corporation. Now when they go to their financial institution, they will look at their personal credit, because all funding decision approvals are based on your personal credit, right? So that's a strategy for corporation. But when you're sole proprietor or you're a partnership, right? If you got bad credit as a if your business is registered as a sole proprietor, if you have bad credit, then that's pretty much it. You can't add any other person on your business. In a partnership, right? If both partners have bad credit or no credit history, then it's also pretty much done. But as a corporation, you have more options, you have more flexibility to get funding for your corporation. So that's why I mentioned that corporation is the most fundable entity that's out there. So that's why you want to incorporate your business. Now on the funding side, on the tax side, you're going to have to talk to a tax specialist. They will even tell you the benefit of incorporating in terms of tax purposes. But for the purpose of this video, I'm talking specifically for funding, how to structure your business or how to structure your corporation so you can get funding. Okay, so very important that you know that. Now once you structure your corporation, right, so you registered it, right, the next thing you need to do is you need to set up a bank account, right? You need to set up your bank account with your financial institution, so that way you can start building that relationship straight from the get-go, right? Because a lot of financial institutions, they consider the day that you opened the bank account with them as the day that your business was officially open. So you want to start building personal relationship with your financial institution. Once you've registered your corporation, go set up a business bank account. Why? Because from the CEBA, the Canada Emergency Business Account, we saw that a lot of businesses were being left out. Why? Because they were operating from their personal checking account. They did not have a business bank account. So a lot of small businesses that needed this funding, that needed this loan, were being left out because they did not have a business bank account, right? So that's why it is important. Once you have your business registered, once you have your business set up as a corporation, you go and set up your business bank account so you can start building that business relationship with your financial institution. Okay, so once you incorporate, set up your business bank account so you can start building that financial relationship, that banking relationship. Now, another thing is this is what we call your North America Industry Classification System code. Very important. When you set up your business, you're going to have to set up a classification code, as you can see here, right? Now, here's, in the banking industry, there are some industries that are considered high risk industry. They have high risk industry and low risk industry. A high risk industry in the banking industry, right, is usually in the banking sector. If you have a real estate business, a lot of financial institutions would consider that as a high risk industry. So there are special program or the special funding program that's available for corporations that are registered as a real estate, that are operating as a real estate firm, right? If you have, as construction is also considered as a high risk when it comes to funding, right? Finance, right? If you are in finance or if you are in insurance, that's considered as a high risk industry, right? Now, this is all based on, just lending, right? In the lending world, some industries are considered high risk. That's just a fact, right? So that's what you got to do your research. Make sure, the business that you set up the right industry classification code, and then also do your own research to know, okay, what is considered a high risk industry and what is considered a low risk industry, because that could be the difference between you getting funding or you not getting funding at all, based on your industry classification code, right? So make sure you choose the right industry, make sure you know your industry, and then also, right, the industry code. That's how Revenue Canada, that's how they're able to track people's expense. So a lot of people want to write off everything. They want to claim everything as an expense. Well, depending on your industry code, they're able to compare industries in terms of, okay, what expense actually makes sense, right? So if you are in the education industry, right, and like there's some expenses that just don't make any sense and you're writing it off, well, when you're doing your taxes, Canada Revenue will be looking at that as like, yo, this person is in this industry. Most businesses in this industry all have the same, spending or expenses, right? So that's how, the CRA, Canada Revenue Agency, are able to know what expenses actually, it's business expense based on the industry code. So make sure you set up the right industry for your business. As I said, you can get denied for funding just for having the wrong industry code, just for being in the wrong industry, right? So you got to know what's a high risk and what's a low risk industry. So do your research, right? Make sure you select the right industry, right? Usually like education, management, professional services, those are considered, and those are low risk industry, right? Now, as I mentioned, if you're in finance or in insurance, which is kind of an irony, because a lot of the banks, they are in finance and banking industry, but yet if your business is registered if you choose finance and insurance as an industry, then you can actually miss out on funding, right? Because as you can see here, right, so these are the different types of industry code. There it is. You have real estate, you have finance, you have art. So make sure you choose the right industry code for your business. All right, so you got your business registered as a corporation. You set up your business bank account, you set up the right funding, or you set up the right NAC code, or the right industry code. So now you're ready to get some funding, right? All right, so when you're ready to get some funding now, what you got to know is this: you got to know the difference between a term loan versus revolving credit, right? So you have everything good, everything is registered, your business is incorporated, your business is set up, you have your business website and everything is good to go. So now you're like, you know what, I need $20,000 loan. Okay, so now you got to know the difference between a term loan versus revolving credit, because the wrong type of loan could be detrimental for your business. The wrong type of loan can actually slow your business growth. They can slow your business from moving forward. Why? Because you are, all your resources is going towards paying off a loan, and you're not making any revenues, or you're not bringing any sales. So that's why you got to know the difference between a term loan versus revolving credit. So let's talk about it. Let's talk about the difference between revolving loan and term loan and revolving credit. So what is a term loan? A term loan is like your installment loan, right? Your personal loan. It's the same thing. In business, in the personal side, it's called personal loan. In the business side, it's called term loan, or installment loan, or business loan. So it's, for example, if you get a $20,000 loan, right? So let's say today's December. If you get a $20,000 loan from a financial institution, next month you got to start making payments on that loan, right? It's a term loan. It has a term. So the term could be 3 years or 5 years. The interest is fixed. The monthly payment is also fixed. So every month you're making the same payment for the next 3 years until you're paid off. So now your principal and your interest is already calculated. So you already know how much you're going to be paying, the cost of you borrowing that funding. So you already know all that. So they'll tell you, okay, you got 5 years to pay it off, plus the interest and the principal. This is how much the whole cost is going to be. So that's a term loan. So you already know everything ahead of time. And usually the banks, the financial institution, they will give you the money up front, right? So they will either deposit it into your account, or they will give you a check, right? So that's what you call a term loan. Now, with the term loan, what happens is this. So let's say if you get approved for $20,000 term loan, if you use $5,000, then basically it becomes a payment only account. So you're just using it to pay it down, you're just paying it. Now, revolving credit, on the other hand, right? Revolving credit is like your lines of credit, credit card, credit lines, and so on. So what is a revolving credit? So a revolving credit is when, let's say you have a line of credit for $20,000, right? So with the line of credit, right, it's reusable. So whatever amount you use, you can always repay it back and use it again. So let's say you have a $20,000 line of credit, which is revolving. If you use 5,000, now you have an available credit of 15,000, and your balance is 5,000. So if you pay back that 5,000, now you're back to a full 20,000, right? So your full credit limit. So because your credit, so let's say your credit limit is 20,000. 20,000 is your credit limit. You use 5,000. Now you have $15,000 that's available, and you owe 5,000. If you pay it back, now you're back to the full 20,000. That's what you call revolving. A revolve, it's based upon the amount, you can reuse it, right? You can reuse it. Now, term loan, you cannot do that. You can't reuse it. Once you use it, it's done. If you want to get another loan, then you're going to have to do another application. You have to go through the same process again of submitting an application, the bank's doing the credit check on you. So that's a term loan, right? Revolving and revolve. Now, the difference between a term, well, one of the advantages with revolving is this. With revolving, whatever amount that you use, right, your credit card company or the financial institution will send you a statement, and you only have to make the minimum payment. You're only required to make the minimum payment that you use, right? Now, you want to make more than the minimum payment, but you're only required by the credit card company to make the minimum payment. Term loan, you have a fixed amount that you have to pay every month, right? So let's say the amount is $600 on the term loan. Every month, you got to make $500 on that term loan, right? Whether you're making money from your business or not, whether sales are slowing down, whether there's no cash coming in, you got to make that monthly payment on that loan. Revolving credit is different, right? Revolving credit is based on the amount that you're using, right? So every month, whatever amount that you use, the credit card company or your financial institution, if you have a line of credit, they will send you a statement, and you're only required to make the minimum payment from that revolving credit, right? And you can make more, you can make more payment depending on how you go. Now, usually with a term loan, right, if you try to pay it off early, there's a penalty. You might have to pay a penalty on a term loan, right? But with revolving credit, it doesn't work like that. So if you have a line of credit, you can pay it off whenever you want, use it, pay it back whenever you want. So a line of credit, credit card, all work the same. So that's why you want to know the difference between a term loan and a revolving credit, because as I mentioned, the wrong type of loan could slow down your business. It could be detrimental to your business. It could be it could be stressful for your business because you're just starting your new business and you're barely making any revenues. You have no customers yet. You're just, building, and you go and get a $20,000 loan, and next month you got to be making a $600 payment, and then you have your rent, and you have other inventory, and then you're not making any. So that could be stressful. So that's why you want to make sure you know the difference between a revolving loan and an installment loan, or a term loan versus revolving credit. Why? Because you want to choose the right type of loan depending on the business that you're in. So if you're just starting out in business, if you're just new, right, then you want to probably go with something with a revolving loan, right? Because revolving, as I mentioned, right, there's no stress. You only pay for what you use. Whatever you don't use is still there. It's available for you. And revolving, you can always increase the credit limit. So if you managing it wisely, if you're using it, you're paying it, you're using it, you're paying it, then your credit card company or your financial institution can give you a credit limit increase, right? With a term loan, no, there's no limit, there's no credit limit increase. Once it's done, that $20,000, and you gotta go again, apply for another $20,000. But with revolving credit, you can always ask for credit limit increase, or if you're using it wisely, if you're managing it wisely, then they will automatically give you a credit limit increase. So that's the difference between revolving credit and term loan. All right, so let's see the next. Now, if you're watching this, if you're looking at this, right, everybody falls within this, what we call a credit profile group, right? So now remember what I said earlier. All funding, if you're starting a business, is going to be based upon your personal credit, right? They're going to look at your personal credit as a business. They're going to look at you, the business owner's personal credit, before they can extend you credit for your corporation or for your business. So you want to know what credit profile group you fit into, right? You either have no credit history, meaning that you don't have any data in the system, Equifax and TransUnion, or you have limited credit history, or you have poor credit history, or you have established credit history, right? So no credit history, basically, right? Let me see if I can lower this microphone here, right? So no credit history means that you've never been in the payments in the credit bureau, right? So you don't have any data. There's not enough data for for the financial institution to approve you for lending because they don't know your payment history, right? It's all based on your payment history, all based on the data that they can pull from these two credit bureaus, Equifax and TransUnion. They want to know, can we trust you with our money? You want to ask, you want to get a $20,000 loan. Can we trust you with this money? How do we know you're not going to run away? How do we know you're just not going to leave the country and then never pay us back? So the banks want to know your payment history. So that's why, a person that has no credit history, it's difficult for banks to give them credit because they just don't know their payment history, how they've used payments in the past. Now, somebody that has limited credit history means that they've used credit in the past, but then they stopped using at a certain point. So maybe you had a credit card or a credit product that you were using actively for 3 to 5 years, and then you stopped, and then and then there's a gap in your credit history. So for the last 3-5 years you haven't used any credit. So you have a person like that has limited credit history, and then poor credit history means that you've had credit, you have poor credit, you went to collection, there's late payment, there's all these negative items that's showing on your credit bureau, right? So that's a poor credit history person. And an established credit history, this person who has an established. Now, what is an established? So very important that you notice. An established credit history is usually in the financial industry. Banks want to see that you have at least 24 months of payment history, right? If you have 24 months of payment history, active payment history, that means that you have an established credit history. Now, it doesn't mean that you have a mature credit history. It just means that you're established. You are in the system. It's not mature, but established. So usually they want to see 24 months of payment history, right? Of you using credit, paying it off, paying it off for 24 months, right? Consistently. So when you have 24 months of credit history, of payment history, then that's considered an established payment history, an established credit history. So with that type of credit profile, right? If you have an established credit history, 24 months of credit history, of payment history, and a credit bureau, then you can get funding for your corporation, because usually that's what banks and financial institutions want to see. They want to see a 24 months payment history from your credit bureau, Equifax or TransUnion. So if you fall in that category, then you're good. Most likely you won't have any issue getting funding for your corporation, right? Now, remember I said that if you have a corporation, even if you have bad credit, you can always utilize the director strategy, adding different directors into your corporation so you can get funding, right? But if your business is structured as a partnership or as a sole proprietorship, then you don't have that flexibility. So that's why it's important that you know that you have the right business structure set up so you can get the most amount of funding, okay? So that's your credit profile. Now, and then you got to know how your credit score is calculated, right? So your credit score is calculated based on, as you can see here, 30% is based on the amount that you owe, right? So the amount that you owe, meaning that let's say you have a credit card for $10,000. So if you have a credit card for $10,000, most financial institutions, they want to see that you're using less than 30% of that 10,000. So they want to see you at, right? So for that $10,000 credit card, they want to see you at under $3,000, right? So don't use more than $3,000. Keep it under $3,000, so under 30%. So that's where most financial institutions want to see you. So that's what you call, that's how your credit score is calculated. So 30% of your credit score is based on the amount that you owe. So the more that you owe on that product, the more point that you're going to lose, right? So if you have a high balance, then you're going to lose more points. So if you over that 30%, so let's say you have that $10,000 credit card and you have a balance of $5,000. So now you're at a 50% utilization ratio. So the difference between available credit and what you owe. So that's what you call your utilization, right? So if you have $5,000 on a $10,000 credit card, your utilization is 50%. So you're going to be losing a lot of points because the way the FICO system, the scoring model is calculated is that, if you're under 30%, you can maximize on the point. If you're over 50%, you start losing some points, okay? And then payment history, right? Payment history is, very important because remember, financial institution want to see at least 24 months of payment history, right? So you see here that payment history pays, it's 35% of your score is calculated based on your payment history. So if you've been in the system for 24 months, then you have an established credit history, right? So your payment history, 35% of it is your credit score. 35% is based on your credit history. Now 10% is based on new credit. So every time you apply for credit, you actually lose points, right? So you don't want to apply for too many credit You don't want to apply for too many credit at the same time too often. So you want to minimize your new credit to, let's say, within a year, keep it under 5, right? Because if banks, financial institution, other lenders start seeing that you have 5 or 6, 7, 8, 10 different application or different inquiries, that's what you call a hard inquiry, a hard hit on your credit report, then they start looking at you as a high risk borrower, right? So that's why you want to keep it under, right, 5 inquiry. And then length of credit, so the longer you've had credit, the better, right? So that's you can pick up a lot of points from there. And then your credit mix, so credit mix is, right, your mortgages, your installment loans, your credit cards, your lines of credit. That's what you call your credit mix, your credit mix. All right, so that's how you structure your business for 2021, so you can get the most amount of funding, because there is funding that's available, but it's just a question of you structuring your business correctly so you can get this funding. Okay, so that's why you want to make sure you have the right type of structure, either as a sole proprietorship, as a partnership, or as a corporation. And as I mentioned, corporation is the most fundable entity, right? Because with corporation, right, there's more flexibility. You can add directors, you can add, even if you have bad credit. But with partnership and sole proprietor, you're very limited. So if you have bad credit, then you're pretty much, you're not going to get any funding because your credit is bad. But at least with the corporation, you can utilize the you can use the the director strategy, where you can add directors to your corporation so you can get funding, right? So just to recap, remember, make sure you have your business structure set up correctly. Set up your business bank account. You make sure you have the right type of code, your NSC code. Remember that code that I was talking about, right? You got to have the right code, because a lot of lenders, there's different industries that are considered high risk and low risk, or you want to make sure that you're not in a high risk industry, because you can miss out on funding on that aspect of it, right? So make sure you have the right industry set up for your business. Your business is registered, and start building that relationship with your bank, and start building your credit, right? Because 2021, there's going to be a lot of funding that's available for businesses, because more businesses are closing. Now there's got to be new businesses to start opening. That's the only way to fill that gap, because a lot of these businesses that are closed, they left a need, right? There's a void that needs to be filled, right? If other businesses don't come in and fill this need, the big corporations are going to come in and fill that need, the Walmarts, the Amazons, right? So there's going to be a lot more funding in 2021, but your business has to be structured properly so you can get the funding, right? So that's what I mentioned. Corporation for funding gives you more option, right? It gives even on the tax side even more option, but I'm not a tax specialist, so I'm not a CPA. So you're going to have to consult with a CPA so they can tell you the benefits that when it comes to a corporation and taxes, right? But on the funding side, I know that you have more flexibility if your business is registered as a corporation to get more funding, because corporations are considered a safe entity. A lot of banks look at corporation as a safe entity. If you're self-proprietor, if you're sole proprietor, if you're a partnership, then it's a high risk entity, right? They're looking at you as like, oh man, this person is, so you just gotta, make sure you have the right business structure set up, right? Your business account, build that relationship with your financial institution, and and then so that way you can get some of this funding. Now, just gonna go back here. I think there's something that I left out that I didn't talk about, which is very important, right? When it comes to right back to lending, right? You have term loan versus revolving credit. Now you also have secured funding versus unsecured funding, right? So now what is an unsecured funding? Unsecured funding is based on, let's say you're asking for a $20,000 loan. It's unsecured, right? The banks are not going to ask for any documentation. They're not going to ask for much documentation. It's just going to be based upon your personal credit profile, your credit score, your credit history, and all that, because the amount is under $50,000. It's unsecured, so they're not going to ask for any security. They're not going to ask for any collateral. They're going to ask for you to pledge your house or anything like that. So that's what you consider unsecured funding. Now, secured funding, usually if the amount is significant, so let's say if the amount is over $50,000, or let's say you're applying for something over $60,000 or $80,000, then that's what you call secured funding. So in that situation, the banks are going to ask for some sort of security pledge or a collateral. So it could be your house, it could be your accounts receivable, your inventories, your equipments for your business, your something for them to secure that loan. Because just in case you don't pay it, right, they have something that they can say that, hey, you know what, we can sell this equipment and then recoup our money back, right? So because you got to look at it from the lender's perspective. Hey, the lenders, they want to make sure, they want their money back. They want to make money, but they also want their money back, right? So an amount that is over 50,000, let's say 60,000, 100,000, right? Usually it's considered a secure, right? The banks are going to ask for some sort of collateral, right? They're going to ask for you to put in some sort of collateral, your house, your equipment, your, as I mentioned, inventories, accounts receivable, so that way they can secure that loan, right? So that is the difference between unsecured and secured funding. Unsecured, as I mentioned, is usually if the amount is under 50,000. So if it's under 50,000, that is considered unsecured. If it's over 50,000, then it's considered secured. Right now, when it's unsecured, everything is just going to be based on stated income, stated revenue. Your personal credit will be the main driving factor in terms of the lending decision. Now, on the because in the beginning, a lot of businesses they don't have any cash flow. They don't have a lot of customers. They don't have a lot of activities in their bank account. In their, there's not a lot of transactions. So with an unsecured loan or unsecured funding, then the banks are only looking at your personal credit profile because they know that, okay, this business is new. They don't have any cash flow. They don't have any a lot of activity. So we're just going to make the lending decision based on your personal credit, right? And there's not a lot of documentation that's required. Everything is stated income, stated revenue, and all that stuff. But on the other hand, secured funding, if you're going for something over 50, 60, 100,000, then expect the banks to come at you, full force with documentation. So that's what you call full doc. They're going to go full doc on you. They want to know everything about your business. They want to know your revenues, your cash flow, your monthly sales. They want to know your profits and loss statement, your tax receipt, your tax for 2029, 2019, 2000, and, they want to know everything. So just like same way when you're applying for a mortgage, when the banks bombard you with documentation, well, on the business side, it works the same, right? If you want a large amount of money, right, significant in the, over 50,000, 60, then expect the bank to come at you full force with full doc. So that's why very important that you understand this concept of unsecured and then secured funding and no doc and full doc, because sometimes a lot of business, right, they end up applying for the wrong type of funding, or the amount that they're applying exceeds what the bank considers as unsecured, and then the bank comes at you full force with documentation. They want to see a business plan, they want to see this, and then your new business, you're like, yo, I don't have all this stuff, right? Why? Because you went over the amount. So that's why you got to know what amount the banks considered unsecured, whereby you don't have to provide you don't have to provide full documentation. Everything is just based on stated income, stated revenue, and your personal credit profile. So you got to know what amount that is, so that way you don't get shocked or surprised. Then they're asking you for so much document. They're going full doc. That's what you call full doc lending. They want to know everything: your tax return, cash flow. They just want, because why? You've exceeded. So that's why it's always good to talk to your financial institution and ask them, what amount do you consider unsecured, so that way I don't have to provide full documentation or no doc, right? So remember, no doc and full doc. Unsecured versus secured lending, right? Term loan versus revolving credit. So you got to do your homework, people. You want to get some funding, you got to know the terminology. You got to know the language. You got to speak the banker's language. You got to sit down with the banker and speak their lingo, speak their language. It's like, yo, listen, I want a revolving credit that is unsecured. Once you start speaking the language, they understand that, okay, this person, they did their research. They know what they're talking about, okay? So, right, that's how you prepare yourself. That's how you structure your business for 2021, right? So you can get the most amount of funding for your business. Because 2021, there's going to be a lot of more businesses that are going to be opening, a lot more businesses that are going to be closing. And if you want to do it properly, make sure you structure your business properly so you can get the most funding. And as I mentioned, right, choose your business structure wisely, either partnership, sole proprietor, or corporation, and then know the difference between term loan versus revolving credit. Know your credit profile, because everything is based on your credit profile. You either have no credit history, you have limited credit history, you have poor credit history, or you have established credit history. And then know how your credit score is calculated, so you can start fixing it, so that you can start knowing how it works, so you can improve it. Okay, so that's how you get ahead of the game, right? It's all about staying ahead of the game so you can win this game, because 2021, you want it to be different, right? You want 2021 to be the best year for you, for your business, so you can get your business up and running. All right, so I am done. I will see you on the next video. As I mentioned, if you have any questions, you can always leave a comment, leave a question, and when I see it, I will respond to it, right? Anything, if you want to know more about funding, if you want to know more about business credit, personal credit, how to improve your credit, well, this is the page for you. This is the platform for you. My Credit Funding. We're all about credit education, financial literacy, and business training. So if you want to know marketing, right? So I want to try to do these live videos more regularly, right? So I might split them, maybe 1 week or 1 day of the week. I'll do more. I'll talk more about credit funding, and then another day of the week I'll talk more about marketing and strategy, and then another day of the week probably keep it like we do a Q&A where you can ask anything about funding, credit, marketing, and so on. So because 2021 is just around the corner, so you want to stay prepared. You want to be close to the right people, the right community that have the right knowledge, so you can take action based on the information that you're getting, right? Because it's all about information. You got to be on the insider information when it comes to credit, when it comes to funding, when it comes to marketing, when it comes to getting your business up and running, right? Because it's something that could take you 5 years, right? If you have the right connection, the right network, the right information, the right people, you can start that in 3 months, in 1 month, right? So it's all about proximity. The principle of proximity says the closer you are to something, to a level, to an industry, to an area of knowledge, the easier it is for you to take action, because you're close to that knowledge, you're close to that industry, you're close to the people that know, right? So it will be easy for you to take action. All right, so as I mentioned, you can leave your questions, so when I get to it, I'll see it and I can respond it, right? And and I was trying to do this earlier on. As I mentioned, technology was a little bit slow, so that's a lesson for everybody, right? When it comes to technology, sometimes it works, sometimes it doesn't work, but you got to be persistent. You got to, right? Because especially when in 2021, technology's got to be part of your business, your business strategy. You got to learn how to use technology to your advantage. Communication, you got to learn how to communicate by using these platforms. A lot of these platforms are free. It doesn't cost a lot of a lot of money. You can just use it and get the word out and become, be more visible, because you're going to have to be visible for 2021 if you're starting your business. People got to know you, they got to find you, they got to search you, right? If they can't find you, then they can't do business with you, because they don't know that you exist. You can have the best product in the market, but if people cannot find you, then you're not going to get customers, right? They got to be able to find you. So you got to be visible on social media, on the internet. You got to make it you got to make it easy for people to find you, people to access you. So you got to use technology to your advantage. All right, so I am out. Peace and blessing. I will see you on the next video.